BMO Insurance, we're not just offering policies. We're delivering trust, innovation, and momentum. With tools like Smart App, Rover AI, and soon SegFund e-application, we're streamlining insurance for advisors and clients alike. Our people make the difference. A national team of experts dedicated to understanding your needs and your market. Here, customer experience isn't a touch point. It's the whole point. We're committed to our communities, supporting local sports teams and grassroots initiatives across the country. Because at the end of the day, insurance doesn't evolve on its own. It takes people, purpose, and the will to do better. Smarter, faster, more human. Welcome to BMO Insurance.
And thank you for joining us today, and welcome to LifeFWD. We're super excited to continue our journey at BMO Insurance with LifeFWD, a new and exciting webinar series that'll help you navigate through the uncertainty, not only in our professional lives, but our personal as well. So why LifeFWD, you might ask? It's about progress, it's about clarity, it's about evolution, and lastly, it's about education. Your business needs to keep pace with the dramatic shifts in our economy and constantly evolving political landscape. Today's webinar aims to move advisors forward with confidence through insights and wisdom. Our series will continue over the course of the next few months, so stay close, tuned in for more information and updates on LifeFWD. Our next webinar will focus on underwriting and your health, where we will be joined by Chief Corporate Underwriter Katarina Nikolic and a special guest from her team. But for now, we encourage everyone to stay with us for the next 30 minutes as you witness LifeFWD. For your friends, colleagues, and associates that couldn't join today, we will be sharing a link in the next few days so they can catch up on what they missed. In addition, our session today is interpreted in 3 languages: French, Mandarin, and Spanish. Our first guest today is Michael Gregory, Deputy Chief Economist with BMO Capital Markets, where he will talk about all things tariffs and the current market uncertainty. After Michael, we'll be joined by Megan Paulin, Senior Business Development Manager at BMO Insurance, to give us a great update that you don't want to miss. But without further ado, please join me in welcoming our guest, first ever to LifeFWD, Michael Gregory. Michael, for joining us today.
My pleasure.
We're honored to have you on our first ever podcast and our webinar series. What I'd like to ask you first and foremost is, I see your name all the time. Every Friday I get my economics forward focus email, and I'm curious, can you share a little bit about yourself? I get to see you all the time, but not all the time do our advisors. So if you could share a little about yourself.
Sure thing. Well, I'm the Deputy Chief Economist for BMO. I've been with the bank now since 2001, so that makes me over 20 years, which seems like a long time, but this feels like it was yesterday. And I basically cover both Canada and the US primarily, but of course, in this day and age, everyone is a bit of a global person as well.
Awesome, awesome. You know what? So many of our advisors don't know what an economist does on a day-to-day. Can you share a little bit of what you do on your day-to-day and what entitles, what aspects involve being an economist?
Sure. Well, our days start pretty early because since I do work in capital markets, we do brief our capital markets traders of what's going on in the global economy. Of course, when we're starting in the morning, Asia is already done trading, Europe is halfway through. So we have to figure out what's been going on, brief and prepare for the data that comes out in Canada. And usually around 8:30, there's a whole slew of data, either in Canada or the US, and maybe a little more later in the morning. So we provide analysis and insight into that for all our customers.
Awesome, awesome. Without further ado, I'll pass you the floor, and thank you so much once again.
Thank you. All right, so we're going to be talking the economic outlook. And I often get asked the question, what's up with the economy? Where's it headed? How are things? And I just say, it's just terrific. Now, of course, I'm making a bit of a joke here because things are far from terrific. What we're seeing now is a tremendous elevated level of uncertainty. And in fact, I've been in this game for a while. I've seen, it's not my first rodeo, so to speak. And this kind of reminds me, the kind of angst we're feeling right now, not only here in the bank, but in all the various parts of the bank, but our customers as well. And that degree of uncertainty kind of parallels what we had in the first few months with the onset of the pandemic, and also during those dark days of the global financial crisis. And in fact, that feeling I have is in fact borne out by some official data. This is a metric put together by folks at Stanford University in California, University of Chicago, and it measures how much uncertainty there is in the marketplace about U.S. economic policy. And as you can see, it's off the charts, the highest it's been in 40 years of data, higher than the pandemic and higher than the global financial crisis. Now, Fed Chair Powell says that this uncertainty is coming from four sort of buckets of policy. Number one, trade policy, and of course, tariffs. We'll be talking about that in a second. Number two, general fiscal policy and tax cuts. We just saw recently that the U.S. Congress, or at least the House, passed the bill, the One Big Beautiful Bill Act, which actually did exactly what the president wanted to do in cutting taxes meaningfully and creating this huge increase in the deficit. But it's also what the richest man in the world was doing for a little while, eliminating whole government departments. There's a lot of uncertainty about immigration policy. We're not seeing those mass deportations yet, but the infrastructure is being built out to take care of that. And of course, regulatory policy. The president said he wants to remove 10 pieces of regulation for every one he brings in. In his first administration, it was 2 to 1. So that's much more deregulation going on. Taxes, of course, cuts are positive for growth, but tariffs and spending cuts and deportations, those are all negative for growth. And that's where the uncertainty is coming from, the fact these things are playing off against one another. But the one that matters most for Canada now is tariffs. We've been caught in the crosshairs of at least the first wave of that. First with tariffs related to fentanyl and border security. Then after that, we had tariffs related to steel and aluminum. Those were similar to the tariffs we had back in the first Trump administration. It's interesting, the fentanyl and border security tariffs, when they first came in, it was 25% on everything Canada exported to the US. But then in the matter of 3 days or so, only those goods that are not compliant with the Canada-US Free Mexico Agreement, the CUSMA, only those goods, or USMCA as it's called in the US, only those goods are subject to a tariff. And finally, we had the tariffs on automobiles and parts, 25% cross-the-board tariff. Now, because of the integration of the North American automobile industry, we get a bit of an exemption for the US content and anything we produce. For example, for all of the vehicles we produce in Canada, about half that content is actually US parts and components. So now Canadian vehicles sold in the United States will not have a 25% tariff, they'll have a 12.5% tariff, but that's still a tariff. We thought we'd get tariffs on parts, but it turns out it's just way too difficult to do that. To keep this in mind, for Canada and the US, when we are making parts and components, often that part or component will cross the Canada-US border 4, 5, 6 times before it gets put into a vehicle in the US. So how do you tariff that every time it crosses the border? There won't be any tariffs there. But of course, then the next big wave of tariff happened on April 2nd. We had the so-called reciprocal tariffs, where the president stood up in front of the White House and talked about all these tariffs and putting on all these different countries. Now, the good news, Canada was exempt from that. But nevertheless, there was 57 countries that ended up above the minimum 10% tariff rate. And now, interestingly enough, that 10% tariff rate was in fact continued and it's still enforced even today. But all of those other tariff rates that were supposed to come in on April 9th didn't do that. You know, those fentanyl tariffs that I mentioned before lasted 3 days. I think these reciprocal tariffs lasted all of 3 hours. And then the president rolled them back for every country that had an above 10% rate, except for one, China. They left China at its 34% rate. And of course, China seeing this, they subsequently put a 34% tariff on the US, and then US responded with 50, China responded with 50, US responded with 84, China responded with 84, US responded with 125, and China did the same thing. And then a couple of days later, the administration discovered that 125% tariffs on all those smartphones and computers coming from China is not a good thing for US consumers. So they changed some of the accounting rules they have to allow those to come in still tariff-free for the time being. And finally, just in the beginning of May, China and the United States agreed to roll all those back for now. So we'll see what happens on July 9th when all those tariffs come back. But for some of you who have been following the news lately, the president threatened a 50% tariff on the EU, although he said that he's pulled that back subsequently. So why this is important for Canada is because we are a major contributor to that trade deficit. Now, the US trade deficit, only 4 countries contribute about 2/3 of that. It's China, the European Union, Mexico, and Vietnam. Canada is further down the list, but if you go eyeball that list, you'll see something that stands out for Canada. It's the amount of exports that the US has to Canada. In fact, the only region that imports more from the US is the EU, but the EU, remember, is 27 separate countries, many of which are bigger than Canada. Simply as a country by itself, Canada imports the most from the United States and in a balanced way. And in fact, all of that trade deficit is explained by a deficit in energy. The US, when you strip out energy, has a trade surplus with Canada. So that's why Canada, unlike any of the other countries except for China, decided they had to retaliate for what was going on. And therefore, they brought in their own tariffs on a bunch of goods, specifically on steel and aluminum and automobiles, and just because of those were tit-for-tat tariffs that the U.S. have put on Canada. But overall, those tariffs, are present, and we're starting to see that. You may even see it yourself, and when you go in the store, and certain goods that come from the United States are just a little bit more expensive than they were before. Importantly, Canada has allowed some of those tariffs not to be imposed when those goods coming in are part of inputs to manufacturing or to food processing. But those aren't the only things we really have to worry about going forward, simply because there are other tariffs coming down the pipe. The administration is looking at tariffs on copper, on lumber, on pharmaceuticals, and semiconductors. And it does look like that Canada is going to not be able to avoid those, particularly on the lumber side. We sell an awful lot of lumber to the US. Plus, importantly, we have the renegotiation or the relook of the Canada-US-Mexico agreement, the CUSMA. And that was supposed to happen the middle of next year, but it's probably going to happen by this autumn. And there's a couple things on the plate that the Americans are definitely going to want to renegotiate. One is the quotas in the dairy industry, and secondly, the labor value content in the automotive parts, and because they want to increase the U.S. content in these things. And finally, and also on the agenda is the digital services tax. That's kind of important, because the administration in their new, at least the one that was passed by the House, they have introduced some new taxes. So for countries that actually have taxes on US companies, like a digital services tax, that allows the US under this new law, hasn't become law yet, it's just a bill, to potentially increase withholding taxes on investments of Canadian businesses and individuals in the United States. So we'll see what happens going forward. So tariffs, they're bad for the economy. They're bad because they create a lot of uncertainty, and that uncertainty breeds an erosion of consumer confidence. Consumers don't buy a lot when they're not very confident. Same thing with businesses. They don't invest a lot. But ultimately, the biggest problem is on the growth side. Nearly 20% of Canadian GDP is exports to the US. So if those are threatened, that hurts growth. More importantly, businesses that are in that space, they think twice about making investments, think twice about increasing capacity. And at the same time, whether it's the US putting tariffs on or Canada putting tariffs on, that increases prices, that erodes purchasing power, which also is a huge hit to growth. We are going to get weaker growth because of these tariffs, both in the United States and Canada. But Canada is going to be hit harder because while near 20% of the Canadian economy is trade with the US, less than 2% of the US economy is trade with Canada. We are expecting the growth to fall quite meaningfully compared to where we were before the tariffs. Before tariffs is January 31st, because on February 1st is when we first started to see those tariffs, how they're the contours of what they would look like. We actually have a very mild recession unfolding for Canada. And then we get a bit of a rebound as we get a little more support from government spending and also from lower Bank of Canada interest rates. Also, another big surprise, quite frankly, has been the Canadian dollar. It was expected to weaken as tariffs were introduced, but in fact, it strengthened a little bit, in part because the US dollar itself has weakened meaningfully as foreign investors have cast their judgment and are not willing to invest in the US to the same degree. But when you think about trade in Canada and the impact across the country, and you look at the provinces, certain provinces are more exposed than others. Provinces like Alberta and Saskatchewan, the energy producing provinces, they have the greatest share of their economy with exports to the US, but a lot of that is energy, and a lot of that will not be tariffed at the end of the day. Ultimately, it's the manufactured goods that are the problem. And as you can see, Central Canada bears the brunt of that. Ontario bears the brunt of that. And therefore, that's causing a lot of the jurisdictions across the board to actually look at increasing government support for the economy. We saw that, for example, in the latest budget after the tariffs, which happened to be from Ontario, huge increases in support. We've seen from the new Carney government proposals also to provide some support for the Canadian economy at the same time. The good news from Canada, for Canada, is the fact that the governments across all jurisdictions went into this period in relatively good financial shape, unlike the US government, and therefore have the capacity to provide some support to the economy from this downturn. So when we look at regional growth going forward, the bottom line is that we expect Central Canada to be underperforming, particularly Ontario. And it's a bit of a shame because when we looked at 2022, 2023, 2024, when we had that huge run up in interest rates, remember, and a huge run up in mortgage interest rates, and that caused the housing market to deteriorate quite meaningfully. And provinces that had greater exposure to housing, like Ontario, like British Columbia, were at the bottom of the rankings in terms of growth. Now that interest rates have come down and housing at least has stabilized somewhat, it's not growing very strongly, but at least it's not declining as much as it did before. Now we have the tariff hit, and that's going to affect Central Canada. So once again, this Ontario and the other Central Canada provinces will be underperforming going forward. All right, so I'll leave it here from now. And then, we'll see what we want to chat about afterwards.
That was fantastic, Michael. Really appreciate that breakdown. There's so many of in our business that don't necessarily, have the time, the energy to research all this information. So that was really fantastic. We've got a few questions. Do you have time for a few questions? Perfect. In the chat, one of the questions was tariffs. Is this becoming the new reality? Obviously tariffs is probably going to be the word of the year. When Google does their search at the end of the year, it's going to be the word of the year. And we've seen it across the globe. But do you think, from your experience, is the new reality tariffs are here to stay?
The fact that I don't misspell tariffs anymore, it's 2 F's, not 2 R's, I think tells me it's going to be here to stay. And it is, because what the administration wants to do is have at least a minimum tariff to help pay for all the taxes they want to cut. So call it 10% on everybody, and a whole bunch of sectoral tariffs like we're seeing on steel and aluminum and other sectors. Maybe Canada can carve out a little bit of an exemption when we renegotiate the trade deal with the United States. We'll have to see. It's kind of hard to say right now. But the bottom line, I think tariffs are here to stay, and at least till the end of the Trump administration, and we'll see what happens afterwards.
Yeah, it's surreal in many aspects to think we're talking about tariffs in 2025, and it's the new reality. One more question from our chat: interprovincial trade. This is something that's come up in the media a few times, and I think for a lot of Canadians, it's a little confusing. How do we not trade interprovincially? And can you provide some commentary on that?
Sure. It's interesting. In the very first Trump administration, 2017 and 2018, Canada had 3 new trade agreements, one with the Pacific Rim, one with Europe, and one with each other. The Canada Free Trade Agreement was what was passed then. The problem with that agreement is if it's that big, that would be the agreement. The rest of that would all be exemptions to the agreement. Every province wants to carve out, wants to have its own population, every control of jobs. So if you have more regulation, you got more people employed. They want to control labor standards and things like that. So so what that meant is that a province has to move forward and try to sort of relax those regulations. Some provinces are doing that. Ontario has said we will relax all regulations for all provinces that do the same to us. Other provinces done the same. It's happening slowly. I still go into the LCBO, the liquor store here in Ontario, and I don't see a lot of BC wines yet, which there should be because they're just as good as California wines.
There's definitely a lot of empty space on those shelves, so hopefully they can get BC in there. Last question with regards to the U.S. tax bill that recently was passed. Can you comment on that?
Sure. Yeah. I mean, obviously, they're cutting taxes like meaningfully over the next few years, and it's only a temporary tax cut. But there was a certain aspect of it that has caused a bit of controversy. Is the fact that because they are opposed to digital services taxes, Canada and other countries put a small tax on the revenues of all the big media companies and on the internet and things like that. And they think that's discriminatory, and they want to stop that. So part of this bill has in there a measure which says that any country that does that, we can increase the withholding taxes we charge investors, either there's a business pulling in dividends from their U.S. operations or Canadians, just regular Canadians holding stocks and getting those dividends. Right now, those taxes are very low because we have a tax treaty that's been in place since the 1940s. Now it looks like those rates are going to go up as a means to get countries to get rid of that digital services tax. Very controversial, but we'll see what happens.
Wow, so much information. I just want to say once again, thank you so much for joining us.
You're welcome.
It's been a pleasure. Our first ever guest on LifeFWD, so this is fantastic. Next up, we have Megan Paulin from BMO Insurance to provide an update on whole life. But before we do that, we have a special video from Jamie Greenfield from Hub Financial. Roll the video.
Hi, my name is Jamie Greenfield. I'm the Chief Operating Officer at Hub Financial. At Hub, we understand the importance of customer experience to our advisors. When we choose an insurance partner, customer service is an important factor in the recommendations we make. At a time when post-sale service in our industry has become challenging, BMO Insurance has made significant strides in reducing the time to process in-force changes. From title changes to in-force illustrations and everything in between, the correspondence is clear, complete, and timely. The team that answers the phone is prompt and knowledgeable. They have put the time and the resources into post-sale service, and it can be seen in industry-leading service times. Congratulations, BMO. Your hard work is paying off.
At BMO Insurance, customer experience is a promise we back with clear, measurable service level agreements. In the last year, new business initiatives and operations teams have driven real results. 99% of in good order new business is processed on time. Out-of-country delivery was enabled through e-delivery. Licensing updates went from 5 days to 1. Calls answered in under 2 minutes, and 100% of payments processed within the SLA. We're streamlining processes, refining forms, and giving advisors the tools to meet and exceed SLA expectations. Our vision? 80% of all tasks handled within 24 hours. Because when SLAs deliver, your business accelerates. Service level agreements aren't just targets, they're the standard. And at BMO Insurance, we're raising it.
Hello, everyone, and thanks for joining me today. My name is Megan Paulin, and I'm excited to talk to you about a product that's making significant impact in the insurance business, BMO Insurance Whole Life. At BMO Insurance, we get what clients are looking for. That's why we've been focused on expanding our reach and delivering products that give Canadians the clarity and confidence to make important life decisions. And I'm proud to say it's been working. We've seen record-breaking sales and an incredible level of momentum. And that's just the beginning. We have other innovative solutions on the horizon, such as Rover AI, so stay tuned for those. For now, we're going to talk about BMO Insurance Whole Life. Let's dive into why it's relevant to what's happening in the market right now. As you just heard from our BMO Economist, market volatility and economic uncertainty are key concerns for many investors. And that's exactly where BMO Insurance Whole Life stands out. It's not just an investment strategy, it's life insurance at its core, offering long-term protection alongside performance. One of the deepest strengths is its low volatility and strategic asset exposure. Whole Life is designed with a smoothing formula that dramatically reduces the impact of interest rate changes. This helps to minimize year-over-year fluctuations and provides more stable, predictable bonus rates for your clients. So, as rates go down, the impact on our product is moderated, offering more consistent, predictable results and more peace of mind for your clients. I'm pleased to announce that we actually increased the performance bonus rate for our Whole Life this year to 5.75%. That's up from the steady 5.5% we've had since 2021. This is a clear testament to the strength of our investment strategy. So what's behind that strength? A big part of it is our enhanced equity strategy, which uses call options to create more consistent returns. This brings a few advantages to your clients. First, it ensures principal protection while allowing the policy to benefit from potential ups in the equity markets. So your clients can participate in market growth without the risk of losing their core investment. Second, the strategy offers longer-term options. This means greater equity market exposure, and we're talking Canadian and US markets at a lower cost. And third, the returns are tied to low volatility indices composed of the least volatile stocks and automatically rebalanced every quarter. It's a reliable approach that helps deliver the kind of stable, predictable performance your clients can depend on. As you can see, since launching in 2017, the product has consistently delivered on what we promised. The actual death benefit has been stable, predictable, and even slightly above the projected bonus rate. That kind of reliability is what life insurance is supposed to offer, and it's what clients are counting on. Our product also has lower sensitivity to adverse interest rate movements than many other products out there. So if market returns come in lower than expected, your clients are less likely to see a significant impact, especially compared to traditional participating policies. Now let's take a look at what's behind that stability, specifically the asset mix that supports our policies. A major strength is our foreign asset exposure. As I mentioned, BMO Insurance Whole Life invests in both Canadian and US markets, which is an industry-leading feature for a whole life solution. The investments supporting our policies includes two main components: enhanced equity exposure and fixed income exposure. Our enhanced equity approach is a combination of long-term call options, low volatility indices, and diversification. The asset mix covers a healthy range from consumer staples to industrials and everything in between. Enhanced equity is managed by BMO Capital Markets, and returns are based on indexes such as TSX and the S&P 500, providing some exposure to growth, but with low volatility. It makes up approximately 30.9% of the portfolio. The other 69.1% is fixed income exposure. This is managed by BMO Asset Management, and returns are indexed to the yield of the BMO Long Corporate Bond Index ETF, ZLC. It covers everything from infrastructure to energy to real estate. These two strategies work together to capture market growth while minimizing downside risk, which of course is especially important when market conditions are volatile. Next, let's take a closer look at some of the key advantages that make BMO Insurance Whole Life stand out even more. Starting with flexibility. The additional payment option allows clients to make extra premium payments anytime, no restrictions, and no need for underwriting. The premium switch option gives clients the ability to extend their premium payment period if needed. With premium offset, clients can use the non-guaranteed values to help pay for the contractual premium. In other words, they can leverage the performance of their policy to help cover future premiums. And with policy loans, clients can borrow up to 90% of the policy's total cash value, providing liquidity when they need it without needing to surrender their policy. Of course, flexibility is only one part of the story. The other is the certainty we provide through our guarantees. Because at the end of the day, this is about insurance, and certainty is the value clients are really buying. Certainty is easily one of the most reassuring aspects of BMO Insurance Whole Life. To start, many components such as expenses, lapse rates, and mortality charges are fully locked in at the time of issue. That kind of guaranteed is built into the product pricing, something you don't always see in traditional participating whole life products. But your clients also benefit from a choice of 3 guaranteed premium payment options, the potential for a bigger guaranteed death benefit for the same premium, and our guaranteed performance bonus formula. It's all about delivering clarity with no surprises down the line. And for the clients thinking long-term, especially those with estate planning needs, this can help offset future tax liabilities. By leveraging tax-deferred growth and the tax-free death benefit, whole life becomes a powerful strategy for protecting more of what they've built. Finally, let's touch on a few key strengths. Our guaranteed 10-pay is our strongest offering, making over 80% of sales by premium, a real vote of confidence from advisors like you. The product performs competitively right up to age 85, especially in our target age range of 40 to 65. And even in a performance bonus rate scenario of -1, it continues to deliver competitive values across all durations. To accelerate the growth of the death benefit and cash value in a BMO Insurance whole life policy, clients can choose to make additional payments above their premiums for their basic coverage, and any riders subject to a yearly maximum. To show how this all comes together in practice, let's look at a quick case study. Claudia and Jacob, both age 55, are a professional couple seeking permanent life insurance as part of their estate planning. They're looking for a tax-efficient way to pass on wealth, ideally with the flexibility to stop paying premiums early, and they're comfortable allocating $250,000. They aren't just investing, they're securing a legacy, and this product allows them to do both efficiently. They consider 2 funding options: a guaranteed 10-pay at $25,000 per year, or a 5-pay at $50,000 per year. They choose a BMO Insurance Whole Life Estate Protector Joint Last to Die Structure 10-pay with a term rider. Here's why it worked. With the Joint Last to Die Term 10 rider and extra additional payment option room, they can pay off their policy in 5 years using premium offset for the remaining original pay period. The additional payment option limit of $23,373 is available as long as the term rider is in force. And even after the term rider expires at year 10, they can continue making additional deposits of $5,634 per year. This strategy maximizes tax-deferred growth and allows them to stop paying premiums early, which aligns perfectly with their estate planning goals. It also sets them up to help offset future estate taxes, giving them more control over how their wealth is transferred. Claudia and Jacob's story is just one of many, but it's a powerful one. It shows how the right strategy and the right product can help clients take control of their financial future. And that's really what this is all about. In a world filled with uncertainty, clients are looking for stability. They're looking for predictability. They want to know that what they're putting in place today will be there tomorrow and that it will perform as promised. BMO Insurance Whole Life delivers on that promise. Between the low volatility, unique enhanced equity, and it helps reduce the worry about the future uncertainty. So when you recommend BMO Insurance Whole Life, you're not just offering life insurance, you're offering confidence and clarity on an important life decision backed by a company that understands how important it is to make it work in the real world. Thank you again for joining me today. I hope this has given you a strong sense of how Whole Life can support your clients and your business. I'm Megan Paulin. It's been a pleasure. Now passing it back to my colleague, Greg Young, to wrap it up.
Thank you, everyone, for joining today. Our series will continue, so look out for information very soon. Our next segment, as I mentioned earlier, will feature underwriting and a special guest. You don't want to miss that. For more information, please reach out to your business development manager. If you're not sure who that person is, please go to BMO Insurance Advisor website. In the top right-hand corner, you'll see the Contact Us tab. Simply click on that tab and you'll find all of our representatives across the country. Once again, thank you so much for joining us today and have a great day. Thank you.